succession planning for small businesses. Now, the title of the presentation mentions family small businesses. Doesn't mean that this is only businesses that we're talking about if you're transferring it to another member of the family, but most small businesses are owned by a family rather than multiple non-related parties. But we'll talk about both of those today. I thought before we get started, I'd have some of the folks here introduce themselves, what business they're here for or that they're representing, and just give us a little brief thing, number of employees, how long been in the Valley, or the area, and what you guys do. And I think that'll help me better when you do have a question. I can maybe answer it more specific to what I think may be applicable to your guys' situation. So
I'll start here.
Knees up.
Hi, I'm Linda Pickett, and I own Modern Cleaners with my husband, and we've had it for 40 years. And we have two locations, one on the west side and one on Fur Street, and we have 15 employees approximately. We're looking for more right now. And our family, none of our sons or children want the business. They went to college and have different ideas on what they want to do. So anyway, yes, so I'm very interested in what Colin has to say, and actually I am a client of Colin's in his office, and they are great if you need any tips on financial planning. And he didn't pay me to say that, right?
So I'm Cameron Thomas. I'm an environmental engineer, and I have my own company, but it's just me. It's a consulting company for the compost and recycling industry. So my clients are commercial composters primarily, and some municipalities in running those facilities. I'm getting to the point where I'd like to think about retiring, but I don't quite know how to deal with that whole issue.
Okay.
I'm Erica Savoy, and I'm with Express Employment Professionals. I'm here for Mark Hagan today, who owns the business. His daughter is not really, she's only 6, but they're thinking that maybe that's not going to be her path. So I grew up in this area, went to work in Everett for a few years, and now I'm back. I've been back in the Valley for 3 months now, and I absolutely love it and don't ever want to leave again.
Good. All right, and like I said, my name is Colin Sands. Our business has been downtown for about 31 years now in Mount Vernon. We have just over 12 employees, and it's myself and one other person that are owners in that, non-family member. So part of what I'll be talking about today I'm quite passionate about because it's something that I live and preach with my business as well, and it's very common in a lot of industries to where there is that business becomes one of the largest assets that one owns, and you want to figure out a way to not just have a retirement plan where it is just work until you can't work anymore and then just close up the shop and throw the business cards away. So you're going to hear mention of insurance a few times today. I want to be clear, this is not about insurance. Insurance is one way that deals with the unfortunate side of succession planning when we have death or disability. Insurance is a very cost-effective tool as opposed to us having large bank accounts with hundreds of thousands or millions of dollars just to write people checks. We're going to also be focusing primarily though on actual transition plans, whether that be grooming a key employee or a family member, or finding an outside person to look at purchasing your business, whether it be a competitor in your direct market or someone out of the market that wants to expand into your market. So we're a small group in here today, so we'll keep it pretty informal. Everyone has a deck of the slide deck, copy of the slides we're going to be going over. Feel free to make notes, just blurt out if you have a question on things. We'll be talking about some stuff that has some references to business entity structure and some tax implications. And just to make sure anything, consult with your tax professional or your attorney. We're going to keep it pretty high level on that because certain circumstances can be very personal, and in the sense that there's lots of different ways things can go. So, but feel free to ask questions whenever. So, small businesses. We have heard a lot in the news in the last, or I should say in the political news in the last couple of years about small businesses. We also hear those referred to as the job creators. I don't know the specific number here in Skagit County, but if you drive around and look around, I'm sure it's more than 95% of the businesses around are all small businesses. And those that are the big box stores or the big corporate names, many of those are franchises that are owned by a local family or a local person. Those folks are a little bit ahead of the game with the franchises, because usually for most franchise agreements, they require a succession plan to help protect the brand. So for those of us that are not part of a franchise, having a succession plan for most of us is typically in the back of our mind. We have an idea of maybe what we'll do. Sometimes that succession plan, as I mentioned at the beginning, is we're just going to work until we're done working and then just see what happens. There's a better way to deal with that, and we'll be talking about that today. Recent study here that came from LIMRA in spring of 2012. LIMRA is a nonprofit organization that does research in the financial and business arena. They put out that 32% of small businesses have a formal business succession plan. I would say in my experience that of this third that do, maybe only a half of those are actually written succession plans. The other half of that 1/3 is someone that says, here's what I had in mind. And in the event that you get to be part of that succession plan, having something in mind puts you in a better position than not having something in mind. But in the event of death or disability, having a succession plan in your mind, that succession plan goes when you do. So of those that do have a plan, as you can see there, 1/4 of them plan to pass it to family members, 1/3 to a key partner or key employee. I do see a lot on the family side where it is more of a forced family type thing, where you have a family member, and as a parent or as a relative, you assume that the family wants it, and they're not outspoken enough to say that we don't. Sometimes those result in bad family business marriages and end up ending ugly. So I would stress that it's important, if it is a family member, make sure that there's an ongoing conversation, that it is the right fit, not just what you assume is the best fit. Your business. So for most small business owners, it is their main source of income, and as I mentioned, it is their main asset as well. And when I say asset, it may be in the form of actual equity, whether it be a business that is very heavy in equipment, such as a construction company or a manufacturing. They have a lot of their assets vested in real estate or machinery and equipment. Or it could be an asset in the sense of income. It may be a services business where you have some real estate that you operate your office out of that has one value, but the main value to your business is generating income for you. So when we talk about protecting this asset, there's 3 things that we're mainly protecting it from. As I mentioned, death and disability, and then the eventual retirement, which is the goal for most people when they have a business, is how do I then stop trading time for money? When we talk about this, we're going to be talking about protecting that asset, making sure that you have a strong plan for your future, keeping your business dynamic and growing, making your business more competitive for acquiring employees and for working in the community, and giving your business that ability to exist into the future in perpetuity, and helping us for a smooth transition when you are ready to leave. So what a written succession plan does, there are a few key aspects to it. First of all, what it's going to do is determine the value of your business and the method or formula in which you use to determine that business. So many industries have different calculations. Some businesses or industries that transition more often than others will see multiples of their gross revenue or multiples of a certain aspect of their revenue. Others will be a valuation based on the book value of the assets of the company, and then there'll be something for what we call goodwill. So when you talk about selling a business, when you sell a business, you're selling 2 things. You're selling the machinery and equipment or real estate, which is much easier to determine the value on, and then you're talking about the name and its presence, and that's what we call goodwill. Those are treated differently for tax purposes, and goodwill is much harder to value outside of not looking at other formulas that are used in that business. So in addition to listing the value for the business and how it's determined, it lists which people will acquire the business or have the right to. It states how and when the business will be sold, and it tells where the money will come from to pay for the business. Now that last one, some of these are not as specific in that. They may address if there is a death or disability, where that money would come from, or if there is a buyout, will that money come from the company buying out one of the partners or owners, or will it come from the actual acquiree bringing in outside money? It may determine what percentage is paid in a lump sum, which portion is carried by the existing owner on a contract, for example. That's the way a lot of businesses are sold, small businesses. There is usually some form of down payment that may come from personal funds or funds acquired through a bank. And there's usually what we call a little bit of a skin in the game clawback, to where that person selling the business will have some vested interest in making sure that the business is successful, because they are carrying a portion of the note to buy that business, whether it be on a 3-year or a 5-year, and many industries are quite different. Some industries, the standard is that there is no, it's you want the business, you're going to come in with all outside money because we're just transferring it. We won't go into too much today about whether it is a stock purchase or an asset purchase. Those have different connotations based on the entity, whether the business is a sole proprietor or a partnership. Those are always going to be an asset purchase or an LLC, because they do not have shares. When we talk about shares or stock purchase, we have S corps and C corps. The main thing to keep in mind here, without getting into the legal side of it, is the difference between an asset purchase and a stock purchase is, from a liability standpoint, when you buy stock, you are inheriting the risk of what's happened in the past. Okay? When you buy assets, you don't have to worry about the risks that the business took in the past. You are just buying the assets of that business. And that may be, from a goodwill standpoint, you are buying the name, you are buying the website, you are buying the customer list, or you are buying the contract that the businesses may have. So those are the main aspects of a succession plan. What does the succession plan do? It helps you avoid losses to the business in the event of something happening, as well as to you and your family, obviously with it being one of the major assets. It helps provide you protection against potential business losses such as management disruption. Usually the owner of a business is one of the key people running the business. If you do not have that succession plan in place and something happens, the business can falter, misstep, deals with the banks and the credit. That bank that was more than willing to renew that line of credit every year when the key person was involved, upon renewal, may have a different mind on that. Many of us on the personal side, we're usually used to borrowing money for a vehicle or for a home. You have a loan, it's good till the end of the term. When it comes to commercial credit, lines of credit are usually renewed annually, and then larger business loans, whether it be on real estate or other things, it may be a payment over 20 years, but every 3 to 5 years, you've got to bring in all kinds of new financial information and sit down with the banker, and they get to see if they want to continue to loan you that money that they've been doing. It also helps keep key employees. Employees are much better off and feel better about their future at a company if they know that if something were to happen to the owner, they know that there is still going to be a job for them and it's not going to be closing up shop. Very often you will see circumstances where something happens to a small local business, and whether it be death or just the business being shut down for retirement, and not only is the person that owned the business out of a job now, the employees are out of a job as well. So that creates uncertainty. It's going to change the type of employees that you're able to get. Drop in morale and obviously loss of customers. One of the key things when you own a small business, and this sounds counterintuitive, is to make yourself as indispensable as possible to the business. The less valuable the owner of the business is to the day-to-day operations, the higher the value of the company, because it means that with that person removed, the business is viable and it can continue to go on. So as business owners, we want to make sure that we are involved in everything and we're the reason that the whole thing moves. But as far as a valuation standpoint goes for transition or succession, that actually reduces the value. The other thing that with a succession plan, we are protecting losses against income, business value, executive benefits, and obviously the legacy, which the legacy means that business going on and continuing on. So the solution to preventing all of this is having a written succession plan and having proper funding or methods of funding in place. That is going to give you stability and liquidity for your business. Now, when we talk about a written succession plan, there is no standard format. There are just the main aspects you want. I've seen succession plans that are 1 page. I've seen them that are 50 pages. It depends on the complexity of the business, the ownership structure, the legal structure, and then the tax ramifications as well. Talk a little bit about a story. about 7 or 8 years ago, a client, 25% owner in a construction services company, passed away. So he had 3 other partners. They did not have a formal succession plan. They just knew that if somebody needed to get out of the business, they would all just take care of it and buy this person out. Well, most of their assets of the business were tied up in vehicles, a little bit of real estate, but the real estate was leveraged because obviously they had a loan on it with the bank, and they had tools and some equipment. The main asset of the business was cash flow. Well, upon the death of this one owner, the wife of the deceased now becomes 25% owner in the company. So one thing I always stress to folks that have a small business, whether you have a partner or that is a family member or a partner that is a non-family member, is if you don't have a succession plan in place, you have potentially set your partner up to eventually be partners with your heirs. Now, in certain circumstances, this is most likely going to be the spouse of the deceased, or in some circumstances, the children. Now, this doesn't mean children as in little tykes. This could be all of a sudden your new business partner is the 21-year-old that's in college that just got done with a business class that has all kinds of great ideas to tell you how to run that business you've been running for 30 years. We do not want to be forced into a partnership with someone that we had no intention of being in a partnership with. Now, in this case, the spouse was not in great financial shape after her husband passed away. She needed to be cashed out of that business. Now, if you can harken back to 2008, the construction industry and construction service industry was not the easiest industry to go to the bank and say, hey, we need a loan based on our cash flow. You can't get a loan on a bunch of service vans and service trucks because they're pretty much already depreciated. There's not a lot of value there, and it's not going to equate what the value is. Now, without that written succession plan, she has the ability to sell her shares. She tried to sell them to the 3 existing partners, but none of them could come up with the cash. They couldn't leverage their own homes because of what was going on in the real estate market as well. So now she is in a pinch, and the other 3 are as well. She needs money, and she needs it now. They want to own 1/3 of the company as opposed to 25% of the company each, but they don't have the means to come up with it. Without that succession plan, she was able to sell that to whoever she chose. It ended up being a competitor in a other market, and that competitor came in, bought her shares at a discount because cash talks, and that competitor was able to take over the customer list, and ensued a long legal fight that ended up costing those other 3 partners lots of money, and eventually them settling and taking a smaller chunk, and now they're no longer in the business, and the competitor owns the entire company. Now, the properly written succession plan, in the event of this one with death, there could have been some what we call cross-sell insurance in there to where, and we'll get into this, but where insurance money could have been used to buy her out. Also, that succession plan could have been written that the owners have first right of refusal to buy those shares. And it could have other stipulations in the manner in which they would buy those shares. Whether it was, even though she wanted a lump sum, that buy-sell could have said that the value of the business will be determined by using such formula, and that amount will be paid out over 7 or 10 or 5 years. And here are the parameters, here's the interest rate that will be used, or the method used to calculate the interest rate. It clearly spells out. And it's a written succession plan for a business, for a good analogy, it's no different than a will. Your will says that when something happens to you, this is what you want to have happen to your assets, this is what you want to have happen to your minor children if you have some. And often when I'm talking with clients, I'll ask them, do you have a will? And they'll say no. And I'll say, well, don't worry, the state of Washington has a will already for you, because there are state laws that protect people without wills, but that means that you are subject to what the state laws say, and that might not be what you want to happen, or it might incur heavy legal costs to do so. So think of a succession plan as somewhat of a will for your business, but it's not only dealing with death, it's dealing with retirement and transition as well. So, planning for what happens next. What we're talking about is if you become disabled, die, or want to move on, the business may have to restructure. So what your succession plan is going to say is, who takes that percentage of ownership? Who takes your functional place on a day-to-day operations? Will your family be forced out? Will they have the opportunity to buy in, or will there not have any opportunity? Will an unqualified spouse or family member become an owner? And this is what I mentioned earlier, as being forced into a partnership. Typical thing where I see this a lot is where we see trusts or family limited partnerships where it deals with real estate. There might be a vacation home or something like this, where it's not a business, but you have a vacation home that grandma and grandpa own, they pass it to their children. It's a place that no one can afford to buy on their own anymore, but they want to keep it in the family. And then as generations ensue and go through, all of a sudden aunts and uncles become partners with nieces and nephews. Parents become partners with children. And what happens from going from maybe 1 or 2 owners, all of a sudden after 2 or 3 generations can be 17 owners. Now it's not as dramatic on a business, but what it is the intention was not to be partners with someone you didn't originally intend to be partners with. If someone just becomes disabled, dies, or wants to quit, can you afford to buy them out on the terms? So you're basically having the conversation with a partner, if you have a partner, or a potential partner, you're having the conversation of how you're going to get compensated, or your heirs or beneficiaries are going to be compensated before you get to the point of selling it. So like anything, when you're trying to negotiate something, talking about something before it becomes a problem or becomes imminent is always easier to work through the details on that. No one likes to make decisions based on short-term forcing of it or having to make them in a reactionary moment. If not to the partner, who else may you sell to? Now this may specify that you could not sell to competitors in a local area. It may mean that it could be sold to an outside person that wanted to be a non-active participant in the business. And it may say that your partner has first right of refusal, as I mentioned, to where they have the ability to buy the business based on the formula and valuation which you've chosen. If they choose to forego that option, who is next in line, or is there no predetermined person that is next in that line? And how will you deal or find a qualified replacement for him or her quickly? Now I mentioned on the insurance side, using insurance as a tool to buy out the spouse or beneficiaries of a partner. But we also talk about key people. So this also means that not only if you lose a key person or an owner of a business do you have to deal with the beneficiary heirs, but if that person was instrumental to the cash flow or viability of that business, it never hurts to have some extra cash flow around if something bad were to happen. So that's another instance where insurance can play a part on the death and disability side. Not on the retirement side though, but we'll kind of get a little bit more into that here. So when you're starting this transition planning process, you deal with the difficult questions first. You deal with everything that could go wrong so that when you get to that point, if something does go wrong, you've already dealt with how it's addressed. So you're planning for the worst and hoping for the best. Understanding the value of your business. For a unique business, it can be difficult to structure the value and say, what is this value worth? That is in a sense where we get into valuing the cash flow of a business. So if someone were to purchase your business or take over your business over time, they may be purchasing a stream of income, or we call it in the industry, buying a job. So a lot of businesses that do sell, the person that is purchasing it, they are, if it's a smaller company, they are buying a job. They're coming up with a lump sum of money or shelling out of money on a monthly basis so they can bring in a little bit more than that, and they're able to, over time, so to speak, own the business without having any liens against it. Choose a strategy that's best for your business. Certain businesses, the strategies for those don't work for others. As an example, for a business that is service related, that requires specific credentials, not any partner or any business partner will do, because that has some barriers to entry. For one that is more dependent on machinery and equipment, something like that, someone could come in not knowing a lot about that industry, but being able to utilize existing employees to help with that. So keep that in mind when looking at the structure for that buy-sell. Source of funds, how is it going to be paid for? Is your industry one that is easy to go get a loan from a bank? Will there have to be some owner financing on it, meaning some what we call carryback? Or is it one that where there are assets in the corporation that are sufficient to where if one did want to sell it, that person could go to the bank and say, here's the business that I want to buy my partner out. We own this real estate, we own this equipment, here are our cash flows. Will you lend me money that I'll personally guarantee to buy my partner out? And for certain businesses and industries, that also is a very viable thing as well. And lay out the plan as a written contract. But again, just like a will for personal purposes, once you do the succession plan, you don't just put it in the file cabinet or save it on the hard drive to get dusty, or have the date change on last modified for those that don't use file cabinets anymore. It's something that needs to be updated. At the minimum, every other year, preferably annually, because things will change. There may be industry changes where things are valued differently, or your business may be changing or evolving. The method of valuing your business may change. Your business may be worth more. You may have acquired more assets. Or there may have been a change in strategy of what you thought was your succession plan with one person now looks like more it's going to be with two people, or there's going to be some other options built in there. Who do you want as a successor? Many of us would prefer to have family. We think this comes into the legacy part. Sometimes, like I mentioned before, family might not always be the best person to do that. They might not be interested in your business. They might not have the aspirations to live where they may have grown up, which the business is typically around the home. A key employer or group of employees, this is typically the most common. Many businesses have that right-hand person that they are looking for, and that person usually shows the interest. However, if your right-hand person is about the same age as you, and they have the same plans for the future, that might not be the right person's succession plan, because they might be operating on the same time frame you are. And if you don't have one key employee, maybe it's a group of employees. We're going from a more of the, if you think about a triangle of ownership where a lot of small businesses look like this, where you've got one owner at the top, maybe it's an inverted triangle where you have more owners at the top. An outsider or a competitor. I mentioned this at the beginning, sometimes competition doesn't have to always be local. It could be that competition that in your same industry, but not most small businesses. Most small businesses fall under that $2 million valuation. Where it is important, though, is for capital gains information. Because when you sell a business, there is taxes that will eventually have to be paid depending on the circumstances, and the lower the valuation that you use, the more it benefits the seller. And if the IRS comes in and says, no, that was not an arm's length transaction, especially between family or closely related parties, they can say that this does not satisfy the IRS requirements. So CPAs are the best to handle this. There are actual designations or certain CPAs that handle just in business valuation and business transition planning. Always a good idea to involve your attorney as well on this, because there are some legal aspects that go into the different types of entities or operating agreements that happen. So let's talk about the two basic types of buy-sell agreements. We have cross-purchase buy-sell and entity purchase. So what this means is that on a cross-purchase, the co-owners are purchasing the prorated shares of the other owner by withdrawing their interest in the business. So with this, you are having outside money, meaning if you have a business with two partners, one partner wants to get out or has to leave because of death or disability, the other partner is bringing money from the outside and just paying them off, and then in exchange for that gets their share of the business. That's cross-sell. Entity purchase or stock redemption plans, more common in larger corporations and more complex situations, is where the actual corporation itself is buying that person out. I mentioned that where the corporation is borrowing money against assets of the company to buy somebody out. The person that leaves, they no longer have any responsibility or liability of the business. The person that stays, they still borrowed money, they just borrowed it on assets of the company. Certain industries are easier to do this, and it also depends on the actual makeup of that company. Now, during a lifetime, how it works with a cross-purchase agreement is you have, for the event of death, you would have a corporation or a partner would take out life insurance on their other partner. What this means is that if something happens to that person, they have a pool of money that they can then use to buy out the family or estate of the other owner. In this example, owner B takes out life insurance on owner A passes away, owner B takes that life insurance money that is tax-free and gives that to the family or estate. Now they own the business. So it's important to remember, and again, consult your tax professional, but when a company pays for life insurance, which is perfectly fine and allowed, it is not a deductible expense. And the reason being is it's different than a company paying for auto insurance for their vehicles or paying for insurance on the building that you own. Those are indemnity policies. They are making you whole on what you lost. If your car gets in an accident, that insurance company is paying you to replace the car. Succession planning or cross-plan insurance, cross-sell insurance, by not deducting it, the business can still pay it, but if you deduct it, you are not paying tax on the seed, so when the insurance proceeds come out, you pay tax on the harvest. Well, typically with insurance, you pay a small premium for a larger reward, so by not deducting it, it makes those proceeds, or can be, tax-free. You're using someone else's money to pay off your partner's family or estate. Very effective way for death. Doesn't work for retirement, unless your retirement plan includes knocking off your partner, which that brings up a whole nother list of issues. So, with an entity purchase agreement, very similar. The business is just paying for the life insurance as opposed to the individual owner. In closely held partnerships, this is typically how it works. Or you have, depending on the structure of the ownership, whether it is a LLC or a corporation, or an LLC taxes a corporation or a general partnership, that's what's going to really determine the way you do this with closely held businesses where you have 1 to 3 partners or even 4. When it starts to get to multiple ownership, obviously things get a little bit more complex. Funding a buy-sell agreement, here's how you fund them. I've talked a lot about installment sales. This is what I refer to as carrying a note. Life insurance and or disability insurance, this can help take care of a partner's income stream if they become disabled. A loan, personal funds, a sinking fund, cash flow. Sinking funds aren't as common. What a sinking fund basically is that the business sets up and puts money into a fund that eventually can be used to buy out partners down the road. More of a contingency fund. Or just the cash flow of the business where there is not an installment sale. Certain buy-sells don't have any type of installment sales. They say if a partner wants to leave, they will receive X percentage of the income or profits of the business for X amount of years. So when they leave, they have no ownership, but they actually will get a payout of the percentage of the business. This might be more similar in very small industries or a very small business where it's a 1 or 2 person operation. And they say, hey, with you not here, I can't guarantee that we have the same cash flow that we had before, but because you started the business or we started this together to buy you out, I promise we'll set up a contract or an agreement that each year or each month you'll be paid out X percentage of the cash flow of the business for a certain period of time. Very common type of method used. Estate planning considerations. This is where it gets more into the planning outside of it on the personal side, but what does your succession plan mean for your own personal estate planning? It's always important to consider that. How are the taxes handled? Taxes are due 9 months after the date of death. Businesses are not very liquid, especially small businesses. If someone is to pass away and own a business and there are tax implications to that, and there is not cash available to pay taxes, you are now forced into borrowing or selling to come up with funds to pay the IRS. They don't wait around. So it's also another reason to be very important to have succession planning with liquidity in the event of death when it comes to estate taxes. What this business plan or succession plan is going to do is it is going to allow you to transform your business into an asset, give you the ability to move on in retirement and transition that and create an income stream or a lump sum of funds. It's going to make your business more viable to your employees. It's going to make your business more lendable to a bank. And it's going to create a lot less stress between business owners and partners and their heirs because everything is spelled out and laid out. And in a time of confusion and chaos, in the event of someone having to leave or someone passing away, the last thing you want to do is have that put stress on the business for the other partner. One thing that I did not address in here is divorce. Divorce is a big thing to where these things are sprung on partners to where all of a sudden now especially in a community property state, depending on other legal agreements, you may become partners with an ex-spouse of someone as well. The buy-sell agreement is going to specify the buyer for the exiting owner's interest. It's going to set the conditions for at least one of the or all of the following situations. It's going to deal with death. It's going to deal with disability. It's going to deal with retirement. It's going to establish the value of the business and how that value is calculated going forward. It is going to obligate you or your estate to sell the business. It obligates the buyer to purchase the business. Something else that's also common in buy-sell agreements is it determines when your partner may exit the business. Some partners may say, you know what, especially if there's an age difference, I don't want to have a partner that wants to stay in this business into their late 80s or early 80s or 90s. It's going to specify when the retirement is triggered, so you've agreed ahead of time. Now what that does is that creates clarity, and a timeline for the business and how things will be transitioned, and again, takes away that tension and wondering, when is this person going to leave if I have a partner, or when are we going to be able to do things a little bit differently, knowing that we need to plan staff-wise or management-wise to handle this. So, next steps. The people, as I mentioned a lot during this, the people that are involved in the succession plan, obviously partners or potential buyer. You want to involve an attorney where needed, as well as a tax advisor. Financial advisors play a good role in this as well, because they help relate this to your own personal financial situation and can help you make sure that you are not messing up one other area of your planning or not creating a problem somewhere else. And having a team of these people working together on this is going to make sure that you have the best possible succession plan. So we are a few minutes away, so I know I covered a lot of material in the last 35 minutes. Any questions or thoughts that come out of this? Yes?
Just one question I would have, like with all the tax code changes that happen all the time with the IRS, is there anything that has changed in this type of information in the last year that we should be aware of? Like maybe we did a agreement, 3 years ago, but there's...
Yeah, there has been a few changes. Obviously, that's more on the CPA side, but what I can tell you is there's been a few new taxes added to unearned income, which would be the sale of an asset. We have a Medicare surplus tax that, depending upon your income and the nature of a source of income, there's additional taxes that did not exist 3 or 4 years ago. So that's why revisiting these things over time is very crucial. Tax law cases happen all the time where things have been challenged with the way that someone treated the sale of a business tax-wise, and there's a ruling that comes out. And so it's always important to know that if you have a plan and a strategy in place and something has changed legally or tax-wise, that what you thought you could do has now been determined that you can't do. You do not want to have that come up afterwards. You've already done that. So that's why it's key to at least once a year, or I should say at least every other year, or most best practice would be annually adjust that and just work talking to your accountant. Should there be anything that we should change or address on this based on what's happened with recent legislation? Yes?
So, in my case, I see sort of two options, barring the death and disability.
Yep.
And one would be to take on a partner or train a successor.
Yep.
The other would be to sell to a larger company that maybe could be in this business that isn't at the time. And anyway, that's an option. So I was just wondering what sort of things to look for, or if we talk about something along those lines.
Yeah, so not knowing a lot about the specifics of your business, the first thing that pops out into my mind based on the description you gave me is selling to a competitor. The value or viability of that is going to be a lot dependent on contracts that you have, because the competitor is going to look at it and say, well, those are contracts that we bid on as well, and if you're not around, they're going to call us regardless, so why would we pay for something that we can already get?
Right.
However, if you have a relationship with the people that you're handling with that, and you have a process, a proven process and structure in place, that provides value. With something like that, many times those types of sales, depending on the industry, that sale will not be a hard line, I'm sale and I'm gone. It is, how about we translate some value in what I have, and I agree to stay on as part of your firm or this new entity for X period of time. That's one. I think that's probably more common maybe. The other option, as you mentioned, would be bringing on a partner or grooming someone to take that position over. Obviously, it's a very specific industry, so there's a lot of knowledge there, so it's not like you can just take an ad out and say, anybody want to join this business? But that would be the one that, depending on your timeline and time frame and options you have out there. So, does that answer your question?
Sort of.
Okay.
Yeah. I realize it's extremely specific.
Yeah, and it's hard not knowing all the exact details. Things to keep in mind, though, would be the method in which you were compensated for the sale. If you were selling to a competitor, especially if there's an employment agreement, that's where it's really going to come down to, is that because usually those happen, the person selling stays on as a consultant. Are you going to be an employee? Are you an independent contractor? Those determine what their say is over what you do. So if you, again, address all of the worst case, what could happen at the beginning, you don't have to worry about them coming up later.
Right.
Um,
What about the obvious inequity? That's something that's always made me nervous in terms of being a one-person small business
Yes.
dealing with a corporation that's got lawyers up the kazoo. It's like, you know, kind of makes you nervous.
Yeah, so, again, that comes down to the specific contracts that you're doing, but I'm sure that, you know, you can have your own general counsel, you can have your own accounting department. They're just people that don't work in the same building with you, and they're your attorney and your CPA.
Oh, absolutely, yeah.
You know, talk to them, ask them if they are okay with you listing them as part of your team when you're presenting or dealing with somebody, as a member of your team, not just saying, well, here's the card of my attorney, or you'll hear, you know, so
Got it.
leveraging them, even though they don't specifically work for you, they're on more of a contract basis.
Got it. Okay.
Other questions?
Make an appointment and you'll get a lot more information. I had no idea this was so time sensitive and that it's
Yeah.
important. Thank you. Thank you.
You're
thank
welcome.
you.
So, like I said, you've got a copy of all the slides. If there's something on there that popped out, we have our contact information. Feel free to email me. There's another piece out there that talks about the business insurance side. A few of the things that we mentioned in here. It's more of just an informational piece to understand what makes them